right. Greed works.
Hello everyone and welcome to episode 15 of Let's Play Wall Street Raider. I'm RakeM, your host. In the last few episodes we have been trying out the autopilot feature. I thought it would be helping us, but instead it's kind of getting in our way. Mostly because we don't understand fully how it works. It's the first time I've ever used it, so I'm still getting used to how it behaves. And for the purpose of this video series, I've been saying that I was going to keep it going till May, maybe till June 1st, and then do an analysis. But last episode ran a little bit long, so instead of doing it then, I saved it for this episode. And in between the end of episode 14 and in preparing to do this episode, I've done some of my analysis because I wanted to kind of figure out what it was that I wanted to analyze, what values I needed to put on this spreadsheet. So here they are, and in the process of putting this together, I've already kind of decided that I'm going to turn autopilot off. But I don't want that to seem like an indictment against the autopilot feature. I actually think it's rather decent. It's just that it's slowing down the series. I'm having to do jump through a lot of extra hoops with this turned on. And with us only getting through like 3 months of game time per episode, if we continue at that rate, and even turning this off, that may be all we can do is 2 to 3 months worth per episode, because we have 45 companies, and they each report earnings once a quarter. So every other day in the game, we have a company on average declaring some kind of earnings report, and we are going to end up going to look at them. And it's a few minutes each time. So with a runtime of 70 minutes per episode, about one quarter, maybe a little bit more, is all we can get through. But in any case, I'm having to jump through a lot of extra hoops with the autopilot turned on. I like what it's doing in some cases, and there's other things that it's doing that I don't like. I have gotten over my fear of dividends. I'm not so much concerned about the autopilot setting dividends up. Most of them are in the 1% to 2% range. The smallest dividend was given to Hartford at 1.25%, and the largest was given to Kraft, which is in the midst of all the what was it with him? Superfund. He's a Superfund site. He was given an 8.3% dividend, but keep in mind that he's got billions in cash that are just sitting there doing nothing, and he's taken a major loss every quarter on Superfund cleanup expenses. So now that we've eliminated his hidden reserve, we should probably think about doing an extraordinary dividend on that and either sell him off or allow him to go bankrupt. But when we do, or before that happens, we need to contribute him to Hormel down here, because we've neglected to do that. We did it for Lukoil, but we haven't done it for him. But anyway, getting back to the autopilot. So the autopilot has the ability to modify your dividend, your growth, and your R&D, number one. So it does that as it deems it necessary, and it looks like, after doing some research, that if you have a dividend, when the system or the game, the simulation, calculates your stock price, if you have a dividend, your stock price gets a boost. And the larger the percentage your dividend is of the net worth, the higher that boost is. Okay, so that's part of the reason why it's doing it. Same thing with growth. The higher your growth rate, the more of a boost your stock gets. And the higher your R&D, number one, if you... And I'm not sure if the R&D, if it matters to the stock calculation, whether you have a higher R&D than anyone else in the industry, but the higher your R&D, the more of a stock price boost you get as well. Now over here under total shares and tax cost basis, the autopilot will initiate stock splits, And I don't have an idea yet what its limits are, like how high the stock price needs to be before it does a split. But most of these stock prices are under $100 a share. Okay, ignore the bank because I'm the CEO of the bank, so it won't split that one. But like the largest one is down here, Warner Lambert. And we only just got done adding assets to it, so it hasn't been split yet. But the majority of these are in the $30 to $50 range. Okay, so I think once it gets up above 75, it considers doing a split, maybe 80. Okay, so as long as you keep your stock prices low, the autopilot shouldn't interfere. But we have 43 of these things, so we're not going to be watching those on a regular basis. The autopilot's going to get to it before we do in many cases. So the other thing that it does, and it doesn't notify you ahead of time, it just tells you when it does it, and it doesn't give you the opportunity to override. But one of the other things that it does is when the parent company has an excess of cash, it contributes cash to its subsidiaries. So your tax basis cost goes up. You're notified on screen. You get a pop-up that tells you, unless you have them suppressed, a pop-up will come up and tell you that it's been done. Okay, but you don't have the opportunity to stop it. Alright, so because we're doing a video series on the performance of the game and how to play it and how to succeed and all that, having these things change constantly is slowing me down from a video production standpoint, and that's the primary reason why I'm going to turn it off. It has nothing to do with the performance of the autopilot. I don't think 6 months is long enough to really determine how well the autopilot does. And in particular, this is not the best time to be analyzing the autopilot. In April of 2022, right now it's May of 2023, so just a little over a year ago was when we had our windfall profits in the oil futures that we had invested in for Royal Dutch, Nippon Telephone and Telegraph, and us personally. And so we had all those windfall profits, and we immediately sold off Royal Dutch. We have now also sold off Nippon, and we have reinvested in all of these 43 stocks. And the only stock on this list that we still own from April of last year is the bank. That's the only one we still have. All of these others, we haven't had them for a year. Every single one of these is less than a year old in terms of when it entered our portfolio. On top of that, we've been merging it with other stocks on a regular basis. And so, we haven't been hands-off with these stocks to see what the autopilot is doing. And typically the way, to illustrate it even further, the way I invest is to take advantage of stock market and stock price volatility. So when I buy a stock, I'm buying it usually somewhere between 80% and 120% of its net value. Okay? Anything higher than that, I consider it usually too expensive to purchase. So I try to buy it in that range, 80% to 120%. And so I buy the stock, and I try to grow its net worth. Okay, so I try to make sure that it's earning income and adding to its net value. Okay, but where you really make your money is off of the premium. A lot goes into this premium. It mainly is consumer confidence in management, proven earnings performance over a long period of time. So if you fail in any of those areas, the stock price is going to dip. But if you succeed in those areas, your net worth will increase, and so will your premium. And it would be nice if these lines were nice and straight in terms of the stock price. If as it went up, it just had a perfectly straight level or not level, but a perfectly inclined trend to its stock price. But that's not what happens. What happens is I buy a stock down here, down low, okay, and for the first 6 months I eliminate, right away I eliminate debt or get their debt under control. I adjust all their management settings, and then the analysts have to go to work figuring out what the new stock is worth. Okay, while that's happening, until there's a market correction in the price, the stock will either stay level or it'll drop. All right, but once the earnings report starts coming out and the income goes up, that's when the stock price starts to climb. Okay, and as more and more earnings reports come out and they are increasingly better and better, the management rating improves, etc. Now all of a sudden we start getting a brand name premium until finally we get up to 500% of whatever it was I invested. And as soon as this stock price pokes its nose above this line, that's when I sell it. Okay, and then I start over. I find another one that is underpriced, and I do the same thing, and I just rinse and repeat over and over. Hopefully, buying about 20% of the market and running it up. Buy 20% of the market again, run it up. And that's typically how you make the most money in the game, in my opinion. There's nothing wrong with buy and hold investing. It just has a smaller return. It's less risky, but it has a smaller return. So, to that end, I also try to maintain a balanced supply-demand situation in the industries that I invest in. And I'm just going to go over quickly how I accomplish that. So when I enter an industry, I typically buy a stock that's underperforming, and I set its growth to something that's moderate, sometimes negative if this black line, which is the demand, is negative. Okay, but the demand for industries doesn't stay the same. It goes up, it goes down. Here we have one that's in the 10 to 12% range, and then it all of a sudden has a drop, and then starts heading back up. Now the companies, all the other companies in the industry together may be growing way up here at 20% because their returns are nice and healthy because of the growth in the demand. All right, but now when it starts to take a dip, they all get worried and they operate in sort of a reactionary manner. Okay, and sometimes they'll continue to grow high even though the demand is dropping because the returns haven't dropped yet. So as long as their returns are high, they continue to grow high until their returns start to drop, and that's when they do a correction. And sometimes that can take 6 months. Okay, so sometimes this drop is not immediate. It's like over here. But anyway, what I do is I try to maintain a supply situation to where it's just under demand at all times. That's what I try to do. So if these companies are growing too high, if they're growing too fast, I'll put a kibosh on their credit, and so they're forced to come down. All right, and then I try to keep them below, and then I do all the growing. I take advantage of this gap between supply and demand, and I have my company grow. Now the reason why this is successful is because as soon as this company, this red one would be me, as soon as this company is above 500% whatever I spent on them at the outset, the industry is still in a good supply-demand situation, so I can immediately re-enter this industry and do it over again. If the industry is out of balance, supply is higher than demand, like it was with pharmaceuticals in the last episode, then we would have to sell it off and not re-enter the industry because the returns would be too low. Okay, so that's my strategy, and the reason why I employ the style that I do is because I can immediately sell my stock for 5 times what I invested and re-enter the industry right away. Okay, rather than having to wait until conditions improve or having to spend 2 or 3 years reforming the industry. All right, so with that out of the way, let's get back to the subject of the autopilot. It's not fair to the autopilot to be judging it when we haven't owned these companies for a year yet. The volatility is still pretty darn high. And so to decide what the autopilot, how successful it is really kind of unfair to the autopilot. Now that being said, I have done the numbers. So what I have here is this is the value, this is the net value of the stock. This is their equity. Or excuse me, no, this is the market cap. That's what I need to put there. Let's get rid of this value. Okay, so that's the market cap for each one of these stocks. So you take their stock price, multiply it times however many shares they have outstanding, and that's this number. The tax basis is what we spent on it. Okay, now it's not perfect because we've done a lot of merging, we've done a lot of moving of stocks around. For instance, Warner Lambert, right here. We inherited him in a bankruptcy. Companies that you inherit in a bankruptcy also include the cost of the bank loan write-off. So they may have had a loan for $20,000, and when you received him through the bankruptcy, his value was $18,000. So he's already upside down. Okay, and the purpose of that is so that you don't have to pay tax on the loss when you sell it. So these numbers are actually inflated, and as a result, the numbers for our return on investment are lower than what they would normally be. Alright, with that being said, let's take a look at a couple of these. The one with the highest stock price to net worth ratio is Microsoft, and we got him in a bankruptcy. Of course, before we got him, before he went bankrupt, we got Adobe in a bankruptcy first. We started to reform Adobe, and then Microsoft went bankrupt, and he was a larger share, had better management, so we merged them and made Microsoft the parent. And then we went out to the software industry and we merged it with several other companies that we bought. Okay, his net worth per share is 604, and his stock price right now is $28.20. But just a few months ago, that was up in the $40 range. And the net worth was like $460 or so, and the stock price was like $46. So he's on the way down, but be that as it may, his stock price is still at a high premium of 467% of the net worth per share. Okay, but our return on investment is only 83%. So based on this number, we'd sell it. Based on this number, we'd keep it. So the only question is, can we grow this back up higher? We got to look and see. I don't know, but this is the best one in terms of stock price to net worth. All right, the best one in terms of return on investment has been Litton. Okay, it was one that we bought. He didn't go broke. We bought him. We had just dismal management, so we upped his R&D. I think it was at 16% at one point, and then we changed the management, and the management turned around. So now he's got great returns. The game gave him, or the autopilot gave him, a dividend. His growth rate is high, his R&D is high, and as a result, his stock price is high. We've got 321% stock price to net worth ratio. Okay, his dividend is 3.5%, and his return on investment right now is 222%. Now, there's still a little bit of room for this one to climb higher. We can expect this to go up to $500,000, the stock price to go to about $120,000. Okay, as long as we keep those earnings up. So it's not really fair to judge the autopilot during the first year of having owned these stocks. It really takes 2 to 3 years for them to achieve their maximum stock price to net worth ratio. But it's taking too long for me to explain what it's doing and figure out what it's doing for the purposes of these videos. And so I'm going to turn it off for now. Maybe when the game has, when all this volatility is over, maybe we'll try it again. Maybe we'll wait and do it as a separate deal in a game that's not 35 years long. But in any case, it's time to turn it off. I like the autopilot. I like the idea of the autopilot more than the execution of the autopilot. But the autopilot's not all bad. It's just, for the purposes of this video series, it's just taking too much of my time to figure out, what all this is doing. So I'm going to turn it off for now, and we're going to proceed without it. All right. So the autopilot is now off. The next thing I want to talk about is the bank. We mentioned at the end of the last episode that the stock price for the bank went from 260 all the way down to 130. He peaked out at 259, and he's at 131.28 now. So his value has gone way down, or his stock price has gone way down, I should say. But that will probably continue because the interest rate is super high. I mean, this is 12%. That's huge. And that's bad for banks. And on top of that, we just took away all of his interest rate swaps. So all the income from those is gone now too. So what I want to do is I want to contribute Irish Life and Perm to STI so that the net worth spike that Irish Life will get from the interest rate swaps will boost the stock price of our bank. All right, so I'm going to transfer that. All right, and also, we just got Pillsbury. Also, there may be loans now, business loans, for companies that didn't have a loan last time we bought loans. So we're going to go out and check and see if there's any more loans to buy. And there's a few, so we're going to buy these. So I'm going to fast forward while I do that. All right, and with the interest rate high like it is, I want to make sure that we have the maximum amount of bonds. All right, so we've got 9, 10, 11, 12, and we have room for 3 more. Okay, so, and the bond price on the government bonds is down to 87, and the return is 11 or 10.5. So we're going to put some more money in those as well. So let's go to the database and find some bonds, and I'm going to leave this other setting, the min-max setting, alone so that we can see all the bonds. We're only buying 3, so we're just going to look for a big number here under the amount publicly traded. All right, so that's 23,000. All right, that's 21 for ICBC. We got some big ones down here as well. Here's 34. Alright, so Travelers, and then the one up here was Westpac Bank. Alright, that's Travelers. Now let's buy Westpac. Alright, and now what's the largest one? There was one for 20. There it is. ICBC. And Kraft's got more problems still. Okay. Now, I want to do the same thing for our insurance companies, Hartford and Swiss, but we'll get to those in a minute. I want to take care of something else first, and that is my commodities. So my commodities, gold has been dropping. I mean, we bought it at 1,000, and it's gone down 200 points since then. And with the interest rate as high as it is, I think it's going to keep falling unless by some miracle the Fed decides to lower rates. So I want to go ahead and get rid of my gold futures and restart those again when the price bottoms out. And if it gets below 700 or down to around 700, we'll probably buy futures and physical gold as well. But we got to wait and see what happens with the price. So if it starts to climb, next time it climbs above 800, or if it climbs below 725, that's when we'll go ahead and do some more futures of gold. All right, so that's the first thing I want to do now. We're going to deal with oil here in just a second. Oil has been hovering in the 120s for a while now. We had the Hubbard's peak scenario, which told us that the world could no longer produce oil as fast as the demand for it, and as a result, the price spiked, and then it dropped, and now it's kind of leveling out. And now that it's leveled out, I want to go ahead and take my money out of it, because I don't know which way it's going to head next. I don't know if it's going to go up or down. And it may just hover here in the 120s for a good long time. And if that's the case, that's fine. We'll just take our profit now, and we'll worry about investing in it later. So I'm going to close my positions on oil as well. All right, what's left is corn, which we sold short, and we want the price to go down. It did. It went all the way down to like 6, might have even been in the high 5s, and it headed back up. It got all the way up into the $9 range, and now it's heading back down again. So I'm going to hang on to it. Silver we bought when the price was around $13.98, I think is when we bought it, and they gave it to us at $14.69. It went down into the $11 range, and we picked up this one, and now it's heading up. So we're going to hang on to it as well, but we want to keep an eye on both of those. All right. So that's that. The main thing is that this is going to be the first time I've ever bought, if this gets down, that is, if this gets down to 725, it's going to be the first time that I've ever bought physical commodities. So I did some reading on that, and there's some costs associated with commodities that we'll talk about when we get there, if we get there. All right, so that's done. Now let's talk about the trade war. We haven't seen anything on the trade war in like a year. I think it's been episode 12, maybe even episode 10, since we've seen any news about the trade war. Now, our growth rate has finally gotten above 0, and it's still pretty low, but I mean, it's better than negative. But we haven't had any news whatsoever on the trade war. Now, it's possible with all the transactions that we've been doing, because we've done thousands of transactions in the last year, that, you know, a notice about the trade war might have come up and we missed it. But, you know, I'm hoping with the fact that the index now is up above 10,000 and the growth rate is positive, that the trade war is almost over, which, if that's the case, our interest rate should drop, our GDP should hike, and we should see some serious, you know, growth on our stock prices. But it'll be interesting to see if we see anything on that this episode. All right, so next we got to deal with Kraft and Lukoil. When I was putting together the spreadsheet, I noticed Lukoil, which is, where is he? Here he is, right here. He's now at a negative 75 on the return on investment. So we can sell him and take 75% of this number, which is around $600 billion, and add that to Arabian as tax loss carryovers. Okay, now Kraft, which is down here, he was 300 billion, and Hormel would basically have, you know, 4 times his net worth, in tax loss carryovers if we sell him, because he's at negative 94%. All right, so what we need to do is we need to do one of two things. We need to check and see if Kraft already has tax loss carryovers, close to this number already. And if he does, then we'll liquidate him. And if he doesn't, then we'll eliminate his cash and then sell him off. Same thing with Lukoil. If he has tax loss carryovers of 600 billion, then we'll go ahead and liquidate him. And if he doesn't, then we'll eliminate his cash and then sell him off. Because there's not that much room left. There's not much more money he can lose to create tax loss carryovers for the parent company. So let's go check on those and see how they're doing. All right, so Lukoil will do first, since he's the larger of the two. All right, his tax loss carryovers is only 4 billion. So we can get a significant tax loss carryover if we, do an extraordinary dividend for this amount and then buy some of his assets, or actually buy some of his assets and then extraordinary dividend, and then sell him. All right, so let's go to Arabian. And let's buy some assets. Why is it asking me that twice? Okay, so Lukoil, and we're going to buy 16,000. Okay, and yes, we'll borrow. All right, now let's have Luko do an extraordinary dividend. And that amount's fine, that's perfect. All right, and now we'll have Arabian selling. All right, so see the difference? That's what we're going to get in tax loss carryovers. All right, so now if we look at Arabian, where is it? Tax loss carryover. I guess we didn't get it yet. Extraordinary losses totaling $533 billion. So we should get that in tax loss carryover on once we declare our earnings. Okay. All right, so that's that one. Now let's go to Kraft. Same deal. We're not going to buy assets. He doesn't have that many. So we're just going to do an extraordinary dividend and then sell him off. Okay. And now we'll have Swiss Reinsurance sell him. Oh, no, we're going to have Swiss Reinsurance donate him to Hormel, and then Hormel will sell him. Alright, and we got Reynolds. We'll have to merge him with British American Tobacco. Alright, but we'll deal with that in a minute. Let's finish what we're doing here first. So here's Hormel. Alright, Kraft's only worth $323 million now. Okay, so sell. And that's at 298. And I don't remember what percentage we're going to get of that. I guess it's around 75% of it as tax loss carryovers. But we'll see in just a minute. We lost 99.9% of our investment in that company. And British American Tobacco made money after being negative. Alright, so let's see. 220 billion. I mean, that's greater than, It's like almost 3 times the value of our company, or well, I guess two times the value, 3 times the net worth. But we'll get those tax loss carryovers when they declare. Alright, so what's next? Next up, we need to look at Siemens. We've done so much reactionary investments and decisions, and it looks like we're filing our lawsuit now, that we need to think ahead a little bit, because what's going to happen here, we have a 33% market share, and GE has a 51% market share, and GE is in major financial trouble. Right? He's got the money that he lost to Hitachi. He has not declared his earnings since he lost that antitrust suit, but his earnings are going to be declared in just a few weeks. And when that happens, he's going to have to do one of two things. He's going to either have to sell off stock to cover this loss, because he has no credit, or he's going to have to sell assets to cover the loss. Now, if he has profit that he can take out of these, he'll do that. But if he doesn't, he will sell off assets. And what that will do, first of all, it'll drive up earnings in here, but it'll also give us a larger market share. So we're probably going to have to sell Siemens before we're ready. And we may even have to take a loss, because if GE sells off a major portion of its market share, we may end up with a monopoly, and we don't have enough assets to sustain the expenses of multiple antitrust suits. So we may end up having to sell Siemens for a loss, and then re-enter the industry and sue Siemens as the antitrust defendant. All right, but in the meantime, we don't want to grow. So if GE goes broke and it sells off a major portion of its assets, the best thing for us would be for Siemens not to be a monopoly in the industry. So we're still growing negative, I believe. And I just want to make sure we're growing negative 10%. Okay, we are. All right, so what we need to do, if we receive any of these, because this guy's going broke, this guy's going broke, Westinghouse is in bad shape. If any of them go broke, we can't merge them. We got to sell them right away. Okay, so we got to think ahead a little bit on this one, and make sure that we don't wind up losing money on Siemens as a result of all these antitrust suits. All right, so that's that. Now, last thing that we need to deal with is my cash. And I'm kind of torn between investing in more in oil, because with this price high, the oil industry is just making money hand over fist. So like if we look at Arabian, okay, his earnings are way up, $3.63 versus 17 cents, and he's kind of plateauing now, but he only has a 32% market share, and we can increase that quite a bit. I mean, all these guys are growing negative, and yet the industry is growing at 6%, and that's going to be sustained for a long term. So what I want to do is I want to increase him by probably about 10%, put him up to like 15-16%. And with these guys growing negative, this industry will still have an improving supply-demand situation. All right, now there's no stocks in here that aren't already controlled that are reasonably priced, except for Lukoil, which we just sold off and we don't want to buy him back. All right, so because he's still got asbestos claims, it's still not over with. So what I'm thinking about doing is giving Arabian some more cash and having him buy new assets or increase his growth rate to like 25% in the short term. Okay, we've got a bank loan, but that's not really a problem because we're still well under the 3-to-1 threshold, plus we have a bunch of cash. So at the minimum, I want to raise him up to 16%. Alright, now what I'm going to do is I'm going to wait and see what happens with the gold price. If it goes up, then I'll go ahead and contribute this money to Arabian and let him work with it. But if this price goes down, then I'm going to hang on to this money because when you buy physical gold, you have to buy it, just like going to the store. You have to pay for it all at once up front. And that's going to run about probably at $700 for gold per ounce. It's probably going to run me about $400 billion, maybe a little bit more. Because when you buy, the max you can buy is 5 million troy ounces, something like that. So 5 times 70, plus all the premiums, plus insurance. It's probably going to run me about 400 billion. All right, so okay, we've been talking forever, and it's time to turn on the ticker and actually get through some of this. We've turned off the autopilot, so ideally I would want to go through and look at all the settings for all of these, but we're just going to do it over the next quarter as they declare their earnings. So let's turn on the ticker and then start looking at those bankruptcies. All right, so first one is Pillsbury. And we have the major market share already, but he's all the way down here at 0% market share, so we can get him. All right, so Hormel. And now let's liquidate Pillsbury. Okay. All right, now what's the next one? Reynolds. All right, so let's go to British American Tobacco. All right, he's got a little bit of room to play with, not a lot. See how much he's worth here. $3 billion. And we'll need to give British American some cash after we're done. All right, let's do that. All right, we now have a 12% stake in the industry. And it looks like we got we haven't liquidated him yet. Let's liquidate him. All right, that's more like it. 18%. All right, now let's look at our debt. We need to get this down 27. So we want to get this down to 7 billion, so we need to give him 5. Call it 6. All right, so our bonds are really low, 6.1%, while our loan is 13.5%, so we're just going to put it all toward the loan. All right. -10, that's fine. 11%. Is our management super bad? Well, it's mediocre. Mediocre. But nobody else is growing that high. Let's back this down to 7%. That'll help out our earnings. We have no dividends, so that's fine. Alright, I think that was it in terms of what the bank owned or received in a bankruptcy. Yep. Okay, so let's start going through the ones that are negative or going, that are dropping from left to right. So he's fine, finally. AMP is fine. 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 Alright, Arabian Oil. He should be up. But he's not. Why is he not up? I guess because we just took a major loss. This loss wasn't booked until now. So we should be back up on the next quarter once this loss has become official. Alright, so I won't worry about that one. British American Tobacco, we just merged with a loser, so we're going to lose money this quarter for taking that loss. This one's fine. Alright, when did we get Burger King? Who owns Burger King? Hormel owns Burger King? How did we do that? We didn't buy Burger King. Where did he come from? Did the autopilot buy him? Did he go back? He couldn't have gone bankrupt because we would have got the notice and have to take him out of the bank. Alright, weird. Alright, so we own 91%. He's 11% of the industry. Industry is growing at a -8 or -3, I mean. Wow, there's finally some stocks to be bought for a decent price. Of course, these two always were, if I remember right. Alright, let's take a look at Burger King. He's got a debt problem. And his management is capable, so that's good. So if we get his debt under control, he should be fine. His stock price is low. Okay, so who do we want to own him on? Over here we had him under, let's see, I gotta go back and unhide the industry. Alright, restaurants is here under Hartford. Alright, let's go to Hartford. He's got 9, 10, he's got 10 stocks, so we could add him there. How many does Swiss have? Alright, that's 9. So Swiss has half a trillion in assets, in stocks, and Hartford has 239. So let's put him under Hartford. Alright, so Burger King. Yes, we're sure. And yes, we're going to buy it from Hormel. Okay. I should have made a note of that stock symbol. Alright, Burger King. And there's the other 9%. Okay, and how much did we say we needed to give him? Alright, we need to get this down to 6 billion roughly, so we need to give him 9. Okay, our bonds are 7 and 7.35. So put it all toward the loan. That should help a lot. All right. R&D 6. No dividend, not until we get out of negative territory and into positive. As soon as we start posting a profit, we can put a dividend on it if we want to. All right, we're going to leave the growth alone. So dividend 0. Productivity 9. Is that what we said? No, we're very capable. We can go with 6. I don't remember what I said before, but 6 is what we're going with. Alright, and the growth rate was fine. -8 is fine. But we don't really need to grow at a negative. We can let everybody else slim down, give ourselves a larger share. Let's make it 0. Okay. Now who did we buy him from? Hormel, right? Wonder how Hormel got him. Oh, he must have been owned by Pillsbury. That must be how we got him. He must have been owned by Pillsbury. Okay, that makes sense. Alright, we're somewhat mediocre. Let's apply this $13 billion towards our loan. Now I realize that we're almost an hour in and we haven't really turned on the stock ticker. I mean, it's only like 2 weeks of game time that we played so far, but we got some cleanup that we have to do. Starting with the stocks that I own directly, I want to eliminate all these dividends so that I'm not taking cash away from any of these companies. So I'm going to cancel all those dividends now. Alright, so that's all of them. And now I'm going to go through on all these companies that are tier 2. If they have a dividend, I'm going to eliminate them if they have a negative return. So they're projected to have a negative here for Verizon. So I'm going to eliminate the dividend on this one, and I'm going to do that for any of the others. The dividend's going to be eliminated if they are making a negative amount on their earnings, and if they're making a positive amount greater than 1% of their stock price, then I'll set the dividend to 1%. All right, STI's stocks, none of the others have a dividend, so now we'll go to the insurance companies. Okay, starting with Mazda, he's got a 1.4. Okay, he's scheduled to make money. So he'll make 264 and his dividend is 196 over the year. So we'll just set his dividend to 66 cents so that he can use the excess cash to invest elsewhere. Or maybe we want to invest elsewhere. So we're about to get Nissan. And he's got a huge debt. So that's what it'll go toward. Okay, so let's just adjust his dividend to 66 cents. Okay, next up, Siemens has no dividend, 3Com. Okay, 40 cents is what he's earning. His dividend is $1.12. His net worth is $88. So at a minimum, I want to reduce it to 0.88. And that would be giving up half of his yearly income. Do I want to make it that high? He's got no debt, really, so yeah, that's fine. Okay, so we'll set his dividend to 88 cents. Alright, next, our brewery, scheduled to make 11 cents. Our dividend is 34 cents. And our value is 21. Got no debt, so we'll set his dividend to 21 cents. Alright, so next, Hormel. Hormel is making 97 cents. Our dividend is 46. Our net worth is 28, so we'll make it 28 cents. I think that's it for Swiss Reinsurance. Yep. Okay, so let's go over to Hartford. Alright, Concentric. Gonna make 62. Our dividend is 29 and our value is 19. So we'll set our dividend 19. $0.28. Currently sell a dividend of 23 and our value is 15. So we'll set this to 15. Okay, next, that's it. Alright, so let's look at our spreadsheet here. See who it is we might have missed. Time Warner Cable and Time Warner. Right? Okay. A&P did well. So let's go to Time Warner. 39 cents is what he's earning. 20 cents is what his dividend is, and our value is only $8 a share. So I'm going to set the dividend to 8 cents. Okay, and Time Warner Cable. I got a message about Mitsubishi Heavy Industries. Caterpillar wants to merge with us. Okay. Alright, Time Warner Cable, 21 cents. Our value is 10. Alright, so we're going to make it 0.1, 10 cents a share. Okay, so we didn't have any that were negative that had a dividend. Of course, he wasn't on our spreadsheet, so let's go take a look at him. Alright, we eliminated his dividend a minute ago. Anybody else growing negative or earning negative? Mitsubishi is. Wow, that's big. Neiman Marcus is. And Siemens is. And Toshiba, which we just got in a bankruptcy. Ooh, we got Westinghouse too. We need to get rid of him. See, because he gives us too large a market share. So we need to sell him right away. Toshiba owns him. Do we want to keep Toshiba? Computer peripherals we've been staying out of. So let's just sell off Toshiba. You know, it's only a couple of $1 billion, but it would be tens of billions in headaches if we get a monopoly in the in Siemens industry. Alright, so Siemens is now declared, and we lost money. Whoops. But we're scheduled to make money next quarter. We're reasonably competent. We got a lot of cash. And since we don't want to reinvest in this industry, oh, see, look, GE, they're now 33% instead of 51%. So we need to look and see what they sold off. And it was as I feared. They sold off the assets rather than the stock. Oh boy, that's going to be tough. Now, the return has gone from 10% all the way up to 36%, so that's good. We can set this to 1% now, and our stock might go up, and then we can get out of this industry or sell Siemens and re-enter using one of the bankrupt guys or a new company. So let's set our growth rate to 1. And hopefully we can get up to like 200% on our stock price. Sell them off and then re-enter and sue Siemens. Because I don't think these guys, either one of them, I don't think they're going to survive for very long. Not if this interest rate stays high. Of course, we don't want the interest rate to stay high. We want it to drop down below 11. So all of our interest rate swaps are at like 11.23%. Okay, government has raised corporate income tax rates to 30%. In order to provide free cable TV, boy, is the whole cable TV industry. Yay! Federal Reserve ends tight money policy, lowers rates. Alright, that's good news for Irish Life and Perm. Alright, our antitrust suit is now coming up against GE with Siemens. And we lost. Okay. And we got Cummins engine. And what industry is he in? Transportation equipment. So we're staying out of that one. He's pretty small, and the whole industry is small, so we'll just stay out of it. We got to get on top of what we already own. We need to, we forgot to trade bonds, government bonds. And with the interest rate going down, we need to do that quick. Wow, and silver dropped. But spot corn is up, which is the reverse of what we want. And gold is down to 745. So I'm glad I eliminated those positions. Alright, let's go to the bank and trade some government bonds. It's going to let us buy 50,000 at a time, so let's do 8 and we'll get about 400,000, 400 billion. That's 1, 2, 3, Okay. That's good. Looks like the bank bought some more consumer loans. I don't know if the autopilot did that or if that's just, it used to be older versions of this game. It would automatically buy or sell consumer loans. But I seem to remember somewhere reading that that the game would no longer do that. And I looked it up in the manual, and the manual doesn't say anything about it now, so I'm not sure if that still is the case or if this is due to something else. I don't know. Alright, let's pause this for a second. 746. I want to look at my commodities. Alright, the 3Com suit's finally coming up. Alright, so I'm negative on corn, no surprise there. It went back down. But silver is still up, but it's dropping. 2026. We used to have like 20 billion in profit on these. I wonder if I traded silver now, what price would it give me at 5 years out? $16. Okay, well that's not as good as what I have now. Alright, we've been going for a while now, and before we end, I just want to get my commodities situated. I know we only played a month of game time, but, I'm going to try to keep these episodes to around an hour. So what I'm going to do is I'm going to leave my silver and my corn futures the way they are, but I'm going to buy the full amount for gold in futures and physical commodities. And then we'll end the part, and hopefully we'll play some more game time on the next one. Alright, so let's do gold futures. And it's going to give it to me at 773. And my hope is with the interest rate going down, that gold will go up at this point. I think that's 4. Oops. Yeah, 1, 2, 3, 4. Okay. Alright, now let's go to physical. Buy. You could afford to buy more, but may not stockpile more than 50,000 units of gold, and thus may only purchase 50,000 such units. Okay. Enter the number of units of gold to buy. 1 unit consists of 10,000 ounces of gold. So I'm buying 5, if I do the max, 5 million ounces times this amount. So 400 billion roughly. Okay, you are cleared to purchase and store 50,000 units of physical gold, 500 million ounces. Get left off a couple of zeros, I guess. 500 million ounces. This is a cash purchase, not a futures contract, and is not being made on a commodity exchange. However, there is a 1% dealer commission. So that's $40 billion, or $4 billion, I guess. And as long as I hold this commodity, storage costs will be incurred based on quantity plus insurance cost equal to about 3% of value per year. Storage fees are $1 per ounce. So I'm going to spend $500 million a year on storage. Storage fees and insurance costs are charged monthly. Okay. So total purchase price was $377 billion, right? Yeah, $377 billion. Okay. And if this goes up to 2200, we can almost triple that, minus whatever our costs are, depending on how long it takes to get up there. Alright. It hasn't dropped my cash yet. There it goes. Alright, so we're going to end the part here. Got good news in that the interest rate's coming down. Hopefully we'll do well on gold. I'm glad I cleared out my oil because it's going back up again. And so we just need silver to rise, gold to rise, corn to drop, and the interest rate not to go any higher. Doesn't matter how much it drops, just so long as it doesn't go above 11. Alright, so as always, please like and share. Thanks for watching, and I'll see you next time. Have a good one.